Okay, so how do you actually do it? Some key steps. First thing is what we call design. So what's it all going to look like? How are we going to put together a plan for your company or your client's company to migrate to employee ownership? Getting a valuation is going to be an absolutely essential early stage step. What price can the company fund and over what time period? How much of the company is to be sold, bearing in mind that to get the tax reliefs it's got to be at least 51%. Who's going to run the trust? So who are going to be the trustees? There aren't really any rules about that. So you'll have quite a lot of scope to decide yourself who are going to be the trustees. And then once the trust has acquired ownership of the company, is it going to retain its shares long term, just like the John Lewis structure, or is it going to pass them through to individual employees so that each employee has their own personal stake in the company? And then you have implementation, second stage. Very important part of that process to get revenue clearance, that tax payable for the vendors, if they do have to pay tax, is going to be capital gains tax rather than dividend income tax. And if you've got that clearance, then once you're in capital gains tax territory and you're selling to an employee ownership trust, then of course you can claim the exemption. Putting the main documents together, for example a trust deed and share purchase agreement, and then also very, very importantly employee communication, so the employees understand what's going on. That's the very first stage in a really important process of working on building up employee engagement in the company so that they get the most out of being owners, as does the company.